Hi, everybody. This is Tammy DeLu here on the Entrepreneur Channel. We are talking today with the author of a book that I really, really enjoyed over the last few months. I've been reading it and rereading it. It's hands down the best passive investing book that I've read recently. It makes passive investing very, very accessible to anyone, regardless of any other kind of investing that you've done in the past. My guest today is Brian Burke. He is the CEO of praxis-capital. He is just a real estate guru, a god among gods, right? Right, Brian?
Well, I don't know. That might be stretching it just a little bit, Tammy.
First of all, it's a fascinating idea, this idea of passive investing. And I know from my own experience, it's not about laying on the couch and doing nothing, because it is, I call it sort of, maybe it's passive aggressive, investing. I'm not sure. But can you explain who you are, first of all, how you got into this business, and what caused you to focus on passive real estate investing versus other things that we could do?
Well, I started investing in real estate actively back in 1989. So it was like, I don't know, 32 years ago. And I started out in single family homes, just buying, fixing up and reselling houses. And then over the years, the company grew into a multifamily operator where, we now own thousands of apartment units. And we've acquired all this real estate, both, our historical single family platform and our current multifamily platform. We're all funded entirely by investors. And it started out where it was just people I knew when I left my full-time law enforcement job to start investing in real estate full-time when I was doing it part-time before. I went to all my coworkers and told them what I was doing, and said, if you guys want to invest with me, I'll split the profits with you guys. And so that was like my first experience with passive investing, where I had my ex-coworkers all investing in my real estate deals, where I did all the work and they provided the capital. And that's really where the whole thing was born. And over the years, it's morphed to where, now we have thousands of clients who've invested a couple $100 million with us, and we've acquired thousands of multifamily units. And that's kind of how we got from there to here.
I mean, you were in law enforcement. That's kind of an interesting background, but it also speaks to the fact that there is a certain, I guess, universality about real estate investing. It's sort of open to anyone from any sort of background, walk of life. It's not just a bunch of rich people. It's not just a bunch of lawyers or CFOs sitting around making these decisions, but it's ordinary people. So how did law enforcement prepare you or get you thinking about what you were going to do in the future?
Well, it prepared me in a lot of ways. On one hand, it prepared me it allowed me to invest in real estate because I was working the swing shift and the weekend shift. So I had essentially most of the business week off to grow my real estate business. But it prepared me for real estate investing because you got to see kind of what I want to call the other side of life. You get to see, kind of the bad side of society, and bad things happen in business, and it really teaches you a lot about how to deal with crisis and, stay calm in an emergency and all those kinds of things. That translates really well into real estate. But I think most importantly, it prepared me for being a syndication sponsor, which is what you might call, it's one of the terms that's used to label our business, where we're accepting investors' money and investing it on their behalf into real estate. It prepared me for that business because on one hand, when I was first getting started, people trusted me because of my law enforcement background. They're like, well, if you can pass all of those background checks, then, that checks the box for me. I can trust you and that sort of thing. And it really helped me raise money way back then. The other thing that it did is it prepared me because when I launched my first fund, and I told you I had all my ex-coworkers investing in this fund to split profits with them, remember who my coworkers were. They were all cops. So now I've got this whole investment fund filled with investors that carry guns and know how to use them. So it really taught me at a very early point in my career the value of preserving capital, because if I knew if I lost these people's money, I was a dead man. And 30 years later, I can say I haven't lost anybody's money ever. And that's been kind of the mantra of our business, that preservation of capital is key, and that really is what's most important in the passive investing space.
I had a lot of friends in law enforcement also. I actually started off there myself years and years ago. That's what I thought I wanted to be, but I did discover something about law enforcement. They are people who you don't want to trifle with, right? So you want to make sure you have a really good reputation. They're also, I would say they're people that are looking ahead. They understand that it's a very physical job. And most of them, would you say, are looking to figure out how to make their money last forever after they retire? Because most of them are going to have to retire at some point. It's very demanding, and it kills your body.
Yeah, they retire pretty young, but the other thing about law enforcement guys and gals is they're not generally all that wealthy, and so they're not your typical passive investing target. But when you're first starting out as an investor that's seeking outside capital, the only way you're going to find any money is going to come from your inner circle. And this was my only inner circle. So literally, I kid you not, when I raised my first fund, my minimum investment was $5,000. That's how small. I mean, now it's 100,000. Wow. So, to have a $5,000 minimum, because, I knew that's all some of these guys had. So this wasn't really as much people going, hey, I'm going to, plan for my retirement, in as much as I had a lot of people who said something like, hey, I've got $10,000 that I set aside for my kid's college fund. My kid's only 5 years old, but I could invest it with you. And so they did, and decades go by, and now all of a sudden, they're, hey, I need to make a withdrawal because my kid's going to college, and the small investment that they made with me paid for their kid's entire education. And so that was really rewarding for me, because it really helped these guys out in a lot of ways. And I had people that took trips around the world, and just other kinds of things they wouldn't have been able to do had they not invested with me. And and then of course there's a lot of them that are still invested with me to this day with the same dollars from way back then.
That's a really good testimony to the kind of job that a good syndicator will do. And I want to talk a little bit about what's the difference in your own words, the difference between a traditional real estate investment, an active investment, besides the fact that you have to deal with people, which is its own nightmare. What's the advantages, you think, of passive investing? Why is it so important, and how would you define it if someone were to ask you, Brian, what is a passive investor anyway?
Well, a passive investor is someone who invests money into somebody else's real estate deal. When I say somebody else's, it's very much their own, but there's somebody else in charge of the day-to-day aspects of the investment. So just kind of a peek behind the curtain of what we do here at Praxis-Capital is we go and we find an apartment complex, for example, and we need $10 million to acquire this apartment complex. We go out to our clients, and they contribute the money, and the whole 10 million coming from a variety of people in smaller chunks. And that's the end of their active responsibility as they make the investment. And then we will close escrow, we'll manage the asset, and then when it's time to sell, we'll sell and we'll distribute the money back out to the investors. So you can kind of think of it like investing in a mutual fund where, instead of you having to go out and go pick stocks and buy stocks and sell stock, you're putting money into the mutual fund, and the mutual fund is doing all that for you on your behalf, and then you can make your withdrawal when the investment's over, in case of a mutual fund, whenever you want. So that's kind of what the passive investment is, but the advantage of it is numerous. When you think about it, you're basically hiring a professional to manage your real estate investment strategy. And a lot of people think investing in real estate is easy, anybody can do it. And while that's true, anybody that has the cash can acquire real estate. It doesn't mean they'll do it right. And so what hiring a professional basically does is, now you get to leverage that sponsor's network, their experience, their deal flow, and all that, just to even find deals. You get to leverage their time because they're going to go out and look at all the opportunities and decide which ones are the best ones. You get to leverage their balance sheet because you got to get a loan to buy the real estate, and that requires a lot of net worth and liquidity, and those sponsors can bring that so that they can get a $20 or $30 million loan that you might not be able to get on your own. You get to leverage the sponsor size and scale, and also the capital of the other investors, because now you can invest in a larger project than you could have invested only on your own, but you get that economy of scale of investing in that larger asset still with this, with a smaller investment of your own. You also get to leverage the sponsor's skills and experience in asset management to make sure the asset's managed properly and the improvements are made and the business plan is executed. All of these things are things that the sponsor does while you're doing something that you enjoy doing, like sailing or golfing or even working in your daytime W-2 job. Your real estate investments are being handled even when you're sleeping.
So this is like perfect for someone who loves the idea of having the tax advantages and the financial advantages of investing in real estate, but doesn't want to get awakened at 2 a.m. because someone's toilet is clogged, right? So the traditional investor, for example, I'm sure you have a lot of people who transition from doing the single family rentals into your bigger projects. What do you find that they have difficulty with in that transition? What is the number one thing you see them doing that probably not in their best interest?
Yeah, the good old tenants, toilets, and trash defense. Nobody wants the 2 a.m. toilet call and all that. That's kind of the quintessential, landlord antithesis. But really, what the mistakes I see people making is they're buying the wrong real estate in the wrong locations at the wrong time or implementing the wrong strategy. Those are probably the biggest mistakes. Investing in a passive opportunity, assuming you're choosing the right one, can help you avoid some of that stuff. So really what it comes down to is not having to hassle with direct real estate ownership and all the disadvantages of it. But really, I think the key advantage for most people is they just have trouble finding something to invest in. And that means, having to go out and go look at property. If you're just investing in a single family home, hey, there's hundreds of them for sale in your local market. You can contact a local realtor. You can tour the houses and decide which one you want. You can buy the one you like the best. Really simple. But if you're in the multifamily space because you want that economy of scale, or you're investing out of your area because there's nothing that really makes financial sense in your area. This is one common thing we get being located in California. We have a lot of Bay Area investors that work in the tech industry, and you could buy a $2 million rental house in Palo Alto and rent it for $5,000 a month, and the numbers just don't make sense. So that means they got to invest outside their area, yet they're working 50, 60 hours a week. They don't have time to go look at 50 properties. And in the multifamily space, we look at probably about 400 or 500 properties for every one that we buy. And some of these properties are located all across the country. So we may have to physically tour 30 or 40 of those for every one that we buy. We look at the financials on 400 or 500 and we narrow that down to 40 or 50, and we have to go look at these properties and then we get one. And that's a massive time commitment. We've got 3 people dedicated to doing nothing but acquisitions and full time. And so, one individual investor can't replicate that on their own. They only have their spare time, which is really limited. So this allows you to leverage your time and not have to do that.
So I'm thinking that this book that you wrote, The Hands-Off Investor, is the culmination of every mistake that you've ever made, everything that you learned the hard way, and you put it into a format that's really easy for people to understand. So if I'm an investor and I come to you and I say, I have $100,000, I want to invest with you, describe to me the process that happens when a person decides they want to go the syndication route.
Yeah, and you're right on the book. It's not only a combination of all the mistakes I've made in my career, but the mistakes I've seen passive investors make in their investing journeys. And a friend of mine who lost her entire life savings investing in the wrong passive investment opportunity and not wanting to see that happen to somebody else. And if I could just prevent that from happening to one person, this whole book will have been worth it. So that was the premise behind the book and kind of what went into it. In terms of the kind of the second half of your question about what happens when somebody's ready to invest in an offering, that part of it's actually the simple part, really. I mean, if we have an investor that says, hey, I want to invest $100,000 in this offering, they just simply go. We send them a link to an invitation to a data room where it's an online data room where they can go and review all the offering materials, click a button to make their investment, fill in their investment account information, and then electronically sign the subscription documents and then wire their funds. That part mechanically is quite simple, but what goes into it, the hard part of it, and this is why passive investing is truly anything but passive, it's a bit of a misnomer. Once you've made your investment, that's when the passivity begins, at least to an extent. You still have to watch it and read your reports and know if the sponsor is on track and make sure they're taking good care of your investment. But the initial part of this, the selecting who to invest with and selecting which deals to invest in, that's anything but passive, and you need to really do your homework and make sure that you're making a good, solid decision. And that's why I wrote the book, was to assist people in knowing what it is they need to know in order to make a good decision when they're preparing to make a passive investment.
Right. So, it's not absolutely required that you know every single thing about investing before you do this, but you do have to know with whom you're putting your money. You need to know a little bit about that person. So if you were looking at a couple of different syndicators, what would be the most critical things that you would want to know as a passive investor, or maybe the questions that you would want to ask that syndicator to give yourself some assurance that they're not a fly-by-night?
Yeah, you nailed it. I mean, that's really exactly what the mission is, right? I told you this story about my friend that lost her entire life savings. She didn't lose it because she picked bad real estate. She lost it because she picked a bad sponsor. It turned out that the guy that she invested with was a convicted felon with former charges from way back when. No, it's not good. He had charges from way back when for wire fraud and and that sort of stuff. So it was all related to financial crime. Essentially, what he did after all these investors made millions and millions of dollars of investments with him, is he basically took all the money and kind of ran. I mean, he was bought a corporate jet and was flying all over the place and just kind of blowing all the money instead of actually putting the money into the real estate where it was supposed to go. So he's actually in prison now as a result of his activities that took place in that investment sequence. So he kind of got what he deserved, but none of his investors deserve what they got. So it's, again, it's the most important characteristic in analyzing a syndication sponsor is their character. Unfortunately, it's also the most difficult to quantify. And, there's a lot of different measurements people will use as a yardstick to grade one sponsor against another. The biggest mistake people make is they just simply look at a variety of investment options and they pick the one that has the highest projected return. That's probably the worst thing you can do. The other mistake I see people make is they just look at the real estate itself and I want to own this kind of it's a mobile home park. I've heard mobile home parks are great. I'm going to go invest in this because it's a mobile home park and it's the only reason that they're doing it. Again, that's another mistake. What you really have to look at is you have to look at the character of the sponsor, and there's a lot of different ways to quantify who they are. One is to look at how long they've been in business. The longer somebody's been doing what they're doing, the more chance that they're doing something right. People can screw up for a while, but eventually it comes back to bite them. And Bernie Madoff was especially good at it. He kept his charade up for decades. I think he's the exception rather than the rule. Most of the time, if people aren't doing things right, or they're not on the up and up, within a couple of years, they've come and gone. So, the longer they've been in business, the more indication is that they're legitimate and that they're honest and they do things the right way. The next thing that you can look for is, have they survived through an adverse market cycle? What I mean by that is, if you think back to like the real estate collapse of 2007 to 2008, if somebody went through that and is still doing this, then they probably got a lot of character and they're probably doing something right, because a lot of those sponsors collapsed during that time and didn't make it. If they were able to survive that, that says a lot of good things about their character. So that's just another thing you can chalk up to. And then, how have they delivered on their returns? That helps to see whether or not the projections that they make are realistic. If they've never hit one of their projected returns in an actual sale, then that's an indication that they might have rose-colored glasses. Another one is, have they actually had a sale? There's a lot of syndication sponsors out there that have bought a lot of property but have never sold a thing. And that's like grading a pilot on his takeoff. So, a pilot who's taken off 1,000 times but never landed hasn't really shown you the full breadth of his skill. So it's important that you see that they've actually been able to cycle deals all the way through. And, that helps to see how well someone performs in this business. So there's a lot of very subtle things to look for. And of course, there's 350 pages in the Hands-Off Investor that's primary message really bakes down to trying to figure out if what the sponsor's telling you adds up or not.
Just being able to discern the baloney from the reality.
The baloney from the filet mignon.
A lot of people, though, Brian, say that real estate is a lot riskier than other types of alternative investments or non-standard, whatever you want to call them, investments. Is it really? Where's the risk in real estate?
Well, everybody says that one investment category is riskier than the other. It depends on what they're selling. If I'm selling Bitcoin, I'm going to say real estate is risky. And if I'm selling real estate, I'm going to say Bitcoin is risky. There's risk in every investment that you make, and certainly real estate is no exception. There's always risk in real estate, and there's really no way around it. And in fact, choosing your sponsor isn't in and of itself going to eliminate risk. So there's basically 2 or 3 different kinds of risk in the real estate passive investing space. I think the most important category of risk to pay attention to is sponsor risk. And this is the one risk that you add into the equation when you're doing a passive investment. If you buy real estate directly, you don't have sponsor risk. But when you're investing passively with a real estate sponsor, you have introduced this new risk component, and that is, does the sponsor a crook? Are they dishonest? Are they knowledgeable? Are they experienced? All of those sorts of things. And we talked a little bit about some ways to weed that out. So that's one element of risk. Another element of risk is it comes in different amplitudes. So one is there's a risk that you could lose all your money. But on the other side, there's a risk that you could just not hit the projected return. Now, both of these are a financial risk, and this is an investment risk, and you can't eliminate it. But there's 2 distinctly different risks at play here. The risk of total loss is fairly low, but one way to increase the risk of total loss is to have too much financing, too much debt on the property and be over leveraged. If you look at all the properties that went to foreclosure back in the real estate collapse in 08 through 2012, the majority of those properties were over leveraged. They had too much debt on them, and whoever owned them, whoever had equity in them, lost all their equity in that foreclosure. So that's one risk, and that's one way to mitigate it. But now another risk is just not hitting the projected return. And there's not a lot of ways to eliminate that risk. In fact, I don't think there's any way to eliminate that risk. There's ways to minimize it. Picking a good sponsor that's knowledgeable and experienced is one way. Picking good real estate is another way. Picking good markets to invest in is another way. Not being over leveraged is another way. But even if you do all those things right, every once in a while, you're still going to get one of those properties that just doesn't hit the marks. And I don't care who you invest with or how good they are, those will happen from time to time. And that is part of the risks of real estate investing. So your best defense is to diversify, invest in multiple investments with multiple sponsors across multiple asset classes, and basically do everything you can to eliminate any single point of failure.
I know we're coming up on the 30 now. I just had 2 more quick questions because I could actually talk to you about this stuff all day long. You're so knowledgeable. But one thing, if you could blow the dust off your crystal ball a little bit and look ahead, what do you see coming ahead in this very volatile and just frankly weird economic situation that we're in here in the U.S.? What do you see the future is for passive and even active real estate investment? Are we going to see a big collapse again? Are we going to see more foreclosures? What do you see coming down the pike?
I see an interesting scenario that I haven't really seen as much in a long time, and at least in probably about 15 years, I haven't seen this, and that's a K-shaped real estate economy. And what I mean by that is you have some markets that are doing phenomenally well. Phoenix, Arizona is a good example. Tucson, Arizona, another good example. Some of the Florida markets, Texas markets, Atlanta, Georgia, the Carolinas, Tennessee, these markets are doing enormously well. Idaho, Salt Lake City. And then you have the losers. It's almost like it's a zero-sum game in a sense. You've got the losers that are just struggling. New York City, San Francisco, Los Angeles. These are markets that are, Seattle is now beginning to suffer. Their multifamily rental market is beginning to suffer. So you're starting to see markets where rents are declining, vacancy is increasing, and things are getting really, really challenging. So again, it's just really important now. Market selection is very important, and picking where you invest is critical to the success of your investing journey.
And that could be an opportunity for some people that have cash to eventually pick up some of these just more distressed properties, I would think. It could be an opportunity for people that are a little more daring, I suppose. They could get out there and take advantage of it.
Yeah, if you have a strong stomach, there could be some opportunities that will materialize in those markets. You know, when there was a ton of foreclosures back in 2008, and we were watching homes in the San Francisco Bay Area that had tumbled anywhere between 30 and 70% in value. And we scooped them up as much as we could. We bought $15 million worth of rental homes at prices, you know, in 2009, 8, 9, and 10, at prices that they had last sold for in the 1980s. And then we watched those prices ride up. We sold those houses for about $45 million about 5 or 6 years later. And it was an incredible trade. Now, maybe you'll see that happen again, where you'll see some values suffer in some core markets, and you know, you could get a trade like that again. But you could also run into the risk that, you know, that market doesn't come back, and that it stays low for a while. And that's a very realistic possibility. Attitudes are changing. The economy is changing. Work from home is increasing, and there's new opportunities now for people to leave those central cities and move to, you know, more remote areas with lower cost of living and keep their old job. That's a dynamic we didn't have before, and that's what fueled, you know, the jobs are what fueled the Bay Area recovery, and they may not be there to do that this time.
And that's very good. I mean, you know, that's one of the few upsides of the COVID-19 pandemic, I suppose. Well, in closing today, like I said, I could have a whole hour and a half with you, and I wouldn't even scrape the surface. Tell us a little bit about the book, where you can get the book, and how people can get in touch with Praxis if they're interested in looking at some of your offerings.
Yeah, so the book is The Hands-Off Investor. It was written to be an insider's guide to investing in passive real estate syndications. It's written for the passive investor, not necessarily the person who's going to go buy the real estate, but somebody who's going to invest in a real estate syndication or fund that's going to go out and buy real estate, and how to choose those investments wisely. You can get the book at bigger-pockets.com/syndication-book. Where you can also get some bonus content for ordering directly from the publisher there. Or you can get it on Amazon, or even a lot of bookstores have it if bookstores are even open these days. And then to get in touch with us, you can follow me on Instagram at Investor Brian Burke. You can check out our website at praxis-capital.com. It's praxis-capital.com. And for more information about our latest offerings, you can go to investwithpraxis.com.
Invest with Praxis, Praxis. I want to thank Brian Burke so much, the CEO of Praxis Capital, for being with me today here on the Entrepreneurs Podcast. Those of you who are interested, even just a little bit, I think you'll find this book fascinating, and it will tell you a lot about the terminology that unfortunately syndicators like to throw around as if everyone in the world knows what they're talking about. So this will give you a good insight into what those terms mean. And you know, if you're thinking about investing in real estate and you don't want to go the route of doing it yourself, passive investing with a syndicator, a good syndicator, like Brian mentioned, is definitely a good thing to consider. So I want to thank you again, Brian, for being on. I will send you a copy of this when it's all edited and pretty. And for everyone else here at the Entrepreneurs Podcast, I'm Tammy DeLue, and have a great afternoon, Brian.
Thank you.